residential put. Meaning, if I buy an apartment, and for some odd reason it goes down in value, I run hard on my luck, I can't find a tenant, I can always just move into it and use it. That's a benefit that you get from physical real estate that you don't get from many other asset classes. There's also the argument that you should buy real estate for leverage. So yes, it's true, compared to stocks, compared to gold or jewelry or antiques, it's possible to get much higher rates of leverage. In the US, for example, it's possible to buy real estate with as little as 20%, sometimes even as little as 5% or less down. Here in Hong Kong, the HKMA has been much stricter about this, but yes, it's generally easier to get a loan against real estate than against other asset classes. One thing that you'll hear some advisors talk about, they'll also talk about the tax breaks of investing in real estate. Chris will be talking a little bit more about the tax consequences, both good and bad, from a US tax standpoint. I'm also going to be giving an example later on how cash flow doesn't equal income in real estate investment. So what are the different types of real estate you can invest in? I'm going to be giving about 12 examples here, and we'll be seeing how those break down asset class by asset class on a slide later on. So the first and most obvious one is residential. This is simply real estate that you can live in, or that somebody will live in and someone will pay you rent to live in. Another class is commercial, specifically office space. Office space is one type of commercial real estate. We're in one example of commercial real estate right now. I pay the owners of this particular floor every month to use an office here. They pay the owners of the building every month to use the office space here. Another type of commercial real estate is retail real estate. So it's a different class when you look at what you're going to buy. If you buy a shop on the first floor of this building, you're generally going to pay much higher price per square foot. It's going to have other factors that determine its value. How many people walk by it? Are they consumers of Louis Vuitton handbags or Chinese herbs and so forth like that? There are also other types of what you might call commercial real estate, which are not the same as office. These would include hospitality and healthcare real estate. So say, for example, running a hotel or running a hospital or running a dental clinic or a medical clinic. There's industrial real estate, which is usually a large-scale building that's meant for a single company or single use. These could be for factories, these could include warehouses, these could include cold storage facilities, and other things which are not really commercial. They're not subdivided like this. Not so much in Hong Kong or in Singapore, but in the US and Australia, you're likely to find agricultural real estate and agricultural REITs. So this, for example, could just be plain farmland, but the most common one that you're going to see when I talk about real estate investment trusts are timber REITs. These generally just own plots of land that have lots of trees on them, and they have contracts to have companies every now and then come down, cut the trees, and pay income, pay royalties to those trees, pay royalties on that asset. So in addition to that, you can also invest in real estate by investing in mortgage loans. So instead of actually buying the property, you can find someone who wants to buy a property and you can provide them the leverage. You can lend them money and you have the security of the property. Also in the US REIT market, and we'll see this when we look at the table, there are specialty REITs such as storage and warehouses, which I've classified under industrial REITs before. There are royalty trusts, which include, for example, oil fields and other specialty types of land that have other sources of value. One thing to be careful here is how they're structured for tax purposes and for ownership purposes. Most of the ones that I'm going to be talking about here are structured or organized as corporations, but they tick a box as pass-through for tax purposes, which I'm going to describe. If they're organized as partnerships, they're going to receive different tax treatment and different tax forms, which Chris might be talking about a little bit later. There's another specialty sector which received a lot of attention last week. I don't know if any of you were watching the news last week. Something happened in the US, and a sector of REITs that hold prisons and manage prisons was affected by that. So what are the economics of a good real estate investment? We talked earlier about what are the reasons you'd want to invest in real estate, partly for the appreciation, partly for income. But let's take an example of what would make a real estate investment successful. So I'm going to make an assumption here that I'm going to buy a $1 million physical property. I'm going to finance 50% of it at 3% interest, which is pretty much in line with what I'd expect if I go to a Hong Kong bank regulated by HKMA, first lien mortgage. I'm going to assume that I earn a 4% rental yield on this $1 million property. I'm going to assume for tax and accounting purposes, I use 40-year straight line depreciation on this property. And I'm going to assume a 4% annual appreciation in the market.
Are these realistic assumptions?
They're fairly realistic. Yeah, I'd say so.
40-year
straight.
standard?
I don't know now. I don't know the exact number. If it's 39 and a half. Or,
Well, I mean, well, that roughly.
yeah, I would say
It's
roughly.
not way out.
It's not way out. It's either 27 and a half or 39. It's somewhere in that range. But I don't. This one. So when I depreciate over a long period of time, it makes the assumption here slightly conservative. But again, that's a tax accounting assumption. It's not an economic assumption. So, so just to kind of give you an idea of how it adds up, the whole point of this slide is to show you that investing in real estate can many times be about cash flow, and it can look like for a while that you're getting tax-free income, but this is why it works that way. So first, on day one, you're going to buy a property with worth $1 million, and you're going to have to take $500,000 of cash out of your pocket to do it. You're going to receive the other $500,000 from the bank. Now this is in 2016. You're not going to receive any rental income or pay any other expenses. We're just doing this at the end of the year. Book value and market value of the property are both $1 million. Now, in the first year, you're going to earn a 4% rental yield. So on a $1 million property, that means you're going to earn $40,000 in rent. I'm just assuming for rough rule of thumb that you're going to pay $5,000 in maintenance, probably to repair some tiles, repair some light switches, whatever else might be in the building. You're going to pay $15,000 in interest, which is 3% on the $500,000 you borrowed from the bank. And then also for the 40-year straight line depreciation, you're going to have a $25,000 depreciation expense. When you take your rental income minus all these expenses, you'll actually see a $10,000 loss, and that means you will not have any taxable income that year, even though you will have a $20,000 net positive cash flow. So first year, it's going to look like you got $20,000 cash on cash return, even though you didn't have any taxable income. You keep repeating that year after year. So for several years, you notice you have $21,000, $22,000, $24,000. All of these are cash that come into your pocket. You have no taxable income because all of your other taxable income is offset by the depreciation expense. According to these assumptions, in the fifth year, and only starting in the fifth year, will you start seeing an economic gain, so an economic profit beyond depreciation. And you'll notice that you should have paid a $236 tax in that case. So here I'm assuming a 25% tax on your net income. But this will actually be offset by all the loss carry forwards you would have had in previous years. So it'll actually be several more years before you actually start paying tax. But in the meantime, you would have gotten positive net cash flow. Now that's part of where you're earning your return. The second part of where you earn your return is you're going to be depreciating the book value of the property all along. But when we're assuming a 4% annual appreciation, we're assuming the market value of your property actually goes up. And so when we talk about depreciation and capital gains taxes, when you go to sell the property, you're going to be selling it much higher than the book value of the property that you have. So those are the two different sources of return. One is the income return, and the other is the price or appreciation return.
You didn't take into consideration of property taxes or rates?
What property taxes? You're talking about the ones that I'd have to pay every year?
No. Oh, isn't there one on the market value of the
Yeah, there would be. In theory, I should have put it under maintenance. I mean, I didn't want to create too many columns.
Oh, okay.
But yeah, you're right. I could create another column for that. I could,
Okay.
the whole idea of this is not
simplified.
I'm trying to simplify it as much as I can. I wanted to fit on a slide. I didn't want to use a 4-point font. Thanks for keeping me on my toes, then.
But is that a significant figure or not really?
It can be, depending on where you are. In Florida, for example, property taxes are over 1% of the property value per year. In other places, in Hong Kong, they're quite a bit less than that.
1%.
In Florida, I mean, Florida doesn't have a state income tax,
Right, exactly.
but it does. But it
makes up for that.
Makes up for property taxes.
Oh, property.
I believe Texas is pretty similar. I don't know how it is in Hawaii or in.
So Florida's one of the highest in the states?
Well, it's one I'm familiar with. I mean,
Yeah,
it's one I know,
understand.
but yeah.
Oh.
California, I know, has a problem with property taxes because they had Prop 13. So if you bought your house in California a long time ago, your property taxes actually won't go up very much.
Yeah.
So you have Larry Ellison, for example, with a multi-million-dollar house.
Yeah.
He pays less property tax on than my mom does. And her house is worth a lot less than her house, than his house.
But I think at the same time, a lot of times the assessed value might be a bit lower than the
Oh,
actual
yes,
purchase
yes, of course,
price.
yeah.
So it might not be 1% of $1 million, might be maybe significantly less than that, which will make it a smaller payment.
So I've so far mentioned the economics of physical real estate, some of the sectors involved in real estate in general as an asset class. Most of what I wanted to talk about here is what is a real estate investment trust, or what it also known as a REIT. So in summary, both, what I'm comparing a REIT here to is any other corporation. My business is I buy stocks and bonds and other listed things that trade on exchanges, and you can look up their numbers in the Financial Times. I like them because they have greater transparency and other benefits we're going to talk about later. But a REIT really looks a lot like a corporation. Both of them are basically boxes into which profits are going to flow, and those profits are somehow going to have to come to you as an investor. But the difference is that when $100 of profit flows into a corporation, a few things happen to it. First of all, the corporation has to pay tax on any of that profit that it's earned. The corporation also has the opportunity to retain any of its earnings and reinvest it in other businesses. And then, and only then, after all of that, it may pay a dividend to its shareholders. So the advantage of a corporation here is that it does have a lot more flexibility in what it does, but it has to pay tax on profits before it can distribute them to anyone. A REIT in that case is a lot simpler. Basically all of a REIT was it was a special type of corporation structured in the United States in the 1960s to say if you tick a few boxes, you invest over 95% in real estate, 95% of your income comes from real estate, you distribute 95% of your income directly to shareholders, you can skip all that, you can skip the tax, and you can pass the dividend straight on to your shareholders. And you won't have any taxation at the corporate level. So how have REITs performed historically? I don't know if any of you saw the article that I published on gold about 2 or 3 months ago, but I was basically making a case why, if you have a long-term time horizon, you shouldn't think about investing in gold. And the reason I was saying is that there's hardly ever been a long period of time when gold has outperformed property. Where, say, if you own real estate, which also protects against inflation, also is a hedge against the decline of your currency, but in the meantime, real estate is something that you can use. Real estate is something that you can rent out and earn income from. Overall, it provides higher total returns. So here, on this chart, this shows returns since 1971 to 2015, so over about 45 years. I can send you pictures of these slides, by the way, if you're interested. It shows the returns of cash, this green line, of bonds, which slightly outperform cash in the long run, of U.S. stocks, U.S. REITs, non-U.S. stocks, and gold. So the purple line is U.S. REITs, and you see that overall they behave more or less like stocks, but in the long run have tended to outperform, and this includes even the great housing crisis in 2008. So overall, as an asset class, REITs have been a good, stable place of long-term returns. I think that averages out to about 12% per year in that period. That includes the 19 of the
For
inflation.
investment professionals, is this commonly known?
Yes, absolutely.
Yeah.
There are whole. I didn't get the slide on this, but there are multi-billion-dollar REIT funds
Yeah.
that invest in this asset class.
Okay.
And you might have seen recently. So S&P only in the past few months actually created a separate sector for REITs. They used to consider REITs a subsector of financials. So financials includes banks and insurance companies, and it also included REITs. But now there's a separate sector just for REITs. So on this slide, I wanted to show a little bit about the difference between physical property versus stock funds. And I could have replaced the charts down here with long-term REIT indices, but I have more data on the stock indices, so I'm just using that as a proxy. This up here is the Centiline index of physical property prices in Hong Kong, and I think this one's specifically on Hong Kong Island. You probably remember the the major peaks and valleys that come in here. This was the Asian financial crisis back in 1997, so property prices here peaked and then they trailed off a lot. And this was the period of SARS, when property prices declined for a while before bottoming out in about 2003, 2004. After that, they've since pretty much been on a straight upward trajectory. In terms of Hong Kong property, the global financial crisis was a bit of a blip. And then since then, it's pretty much been upward. Since in the past few years, you've seen a little bit of a dip, but nothing like the massive 20-30% correction that I keep hearing about that you're going to see in the Hong Kong property market. By comparison, the Hong Kong stock market, as measured by the Hang Seng Index, it looks outright wild. I mean, you look at what happened in the global financial crisis. The correction from 30,000 to 15,000 was not a blip. It was a much larger and wilder swing than it was in physical real estate. But one of the main reasons for this, does anyone have an explanation on why physical property doesn't swing as much as stocks?
Liquidity?
Well, partly liquidity, but wouldn't you also say it's because if property values go down, me as a seller, I just might not sell. You know, you're more likely to just see a withdrawal in volume, which you're not as likely to see in stocks as you would in property. But yeah, I think you're absolutely right. That's another way of saying the same thing. Here I just wanted to compare over a different time period. This one went all the way back to the late 1980s, and this was 1994 for stocks, and this is for Hong Kong. This is for the US. So this one is showing the S&P Case-Shiller index of US house prices and comparing it to the S&P 500 for stocks. You notice the S&P 500 also had a big dip here around the US housing crisis. But also has been much more stable and has recovered better than houses in the U.S. have. So I want to quickly compare with REITs in the middle. What's the difference between stocks and stock funds versus REITs versus physical property? So if we compare their historical returns, as we'd see in the previous chart, first of all, the historical returns of stock funds, and REITs, both of them are actually quite high, are very high. With physical property, I would say probably not moderate. They're probably moderate to high, really depending on how you account for your expenses, how you account for things like property taxes and other maintenance and other headaches that go into them. The historical risk, I was trying to compare on the previous chart. Stocks tend to be very high risk, as we saw with the Hang Seng Index. REITs are slightly less risky than stocks. But if you just look at plain old volatility, property might almost look the safest. Now, safe there could be a little bit misleading because we're saying the prices don't fluctuate up and down as much on a chart. But you have other risks with property, as for liquidity, for example. If you want to sell $1 million worth of an apartment, you may not be able to do that right away. You may not be able to do it for months. But if you want to sell $1 million worth of REITs, you could probably get out of it within an hour, depending on how liquid your REIT is. So that's what we were mentioning here with liquidity. Stocks tend to be very liquid. REITs tend to be almost as liquid as stocks. Physical property is really not that liquid at all. Another advantage that I really like of REITs is diversification. So one of the problems I have is, let's say, for example, you have $10 million and you want to invest it in property. Here in Hong Kong, you might be lucky to find actually one property that you could put in for $10 million. But if you wanted to put $10 million in property and go into the REIT market, I could divide it among 10 different REIT markets for you, and you could put $1 million in the US market, $1 million in the Canadian market, $1 million in Hong Kong, $1 million in Singapore, $1 million in Japan, $1 million in Australia, $1 million in the UK, $1 million in Germany, and you could spread it out and you'd be broadly diversified. That way, if you needed to take out $1 million, and if any of those markets was performing poorly, if any of those markets was performing well, you wouldn't have to sell into a distressed market. You wouldn't have to worry about selling at the bottom or giving it all up to liquidity. One of the differences we also mentioned earlier was about financing. Stocks and REITs trade like stocks on stock exchanges, and if you want to get additional financing for them, you finance them generally on margin or on repo, or the same way that you would finance another stock or bond. One other thing about REITs, though, is that because they operate as companies, they also have leverage already embedded in them. The manager of a REIT will already go and borrow money on an institutional level for, say, $100 million worth of a building. And they do it on a scale which is better than most individual investors can find. If you buy a physical property, though, you can go and finance it on a mortgage loan. And this MTM that I mentioned here, if you take out a margin loan, the broker or the lender is going to look at the mark-to-market value of your stock at any moment, and they can liquidate it if the mark-to-market value moves. The nice thing about mortgage financing is that there's no mark-to-market. If you borrow money for your house, they're not marking your house to market and saying, oh, the property market's down, we've got to sell your house and get you out of that mortgage now. So it's a plus or minus on both sides. Every time I look at an investment, I always like to ask myself, how do I lose money in this investment? In stock funds, besides volatility and trading at the wrong time, you can also lose money by paying too much in fees. Basically, if you trade too frequently, if you buy high and you sell low, you'll lose money in stock funds. Same thing with REITs, but in addition, you can also lose money by poor selection. If you buy into a REIT that a lot of crappy property has been dumped into, and if you trade frequently, that's another way of losing money in REITs. So if you buy physical property, you also have the property of poor selection, but you also have unexpected hazards and expenses. I have personal experience investing in property right up by the escalator in Soho, and some of you who know me and know my story know that I had a tenant who was someone from the mainland who I believe got in trouble with the law and got arrested. And I spent 3 months at the Lands Tribunal actually trying to get her evicted. When by the time I finally got her out, the place was a total mess, and it was a lot of both legal and personal cleanup that I had to do to get it out. Thank goodness Hong Kong has good title on land and good respect for property rights. If any of you have seen the Chongqing Nail House in Chongqing, there was a house where the owner didn't want to move, and a Chinese property developer wanted to develop that area. So that family just stayed right there, and you'll see an enormous hole in the ground where they dug around it and wanted to build, and that family still wanted to stay in that house. China probably doesn't have the same respect for property rights as we do here in Hong Kong or in many of these other countries that I look at, but that's one of the risks you have to worry about with physical property.
Why do REITs give a higher historical return than physical?
Why do they give a higher historical return than physical property? I would say part of it is just how you account for the return. But I admit part of that there might just be a data problem. So for one, I was looking at house prices on physical property, but for REITs I could get total return including dividends. So I admit it's much harder for me to get what's the total return when I get in physical property. Short answer is I don't have a good index for that.
Well, I suspect that REITs are also less likely to invest in rubbish property.
Well, it's professionally managed.
Whereas some landlords are bound to be.
Well, it's true. But on the flip side, if you can invest in physical property, you might also have a better chance of finding a really distressed place, like finding one where someone died.
We're talking averages here.
We're talking averages here. The biggest mistake I tend to see of investors in physical property is they tend to ignore their expenses. They look at that and they say, "Oh, I bought this property for $1 million. I sold it later for $3 million." It's like, okay, now how much did you earn in rental income in the meantime? How much did you spend on property taxes? How much did you spend renovating it in order to get all of that? And a lot of times I don't hear a good accounting for what their total cost was and their total return was. So, but good catch on that. So this is on the comparison between stocks, REITs, and physical property. Next, I want to give a quick picture on what the different sizes of the different REIT markets are like around the world. So it may or may not surprise any of you that unlike the global stock market or global bond markets, the US still dominates the global REIT market. So the US was the first place that actually created REIT laws and actually established the tax law for REITs. And the U.S. right now has about $1 trillion in market cap in REITs, and we're going to see later how that breaks down. So by comparison, you have much smaller REIT markets. So roughly in order in continental Europe, Japan, Australia, the UK, Singapore, Hong Kong, and the smallest one I follow is the one in Canada. We're watching development of REIT markets in other markets around Asia. India and mainland China have both been talking for a while about how they would put the rules in place, but we're still waiting to see listed REITs in those markets. Same also with Southeast Asia. This is in a little more detail if you like numbers as much as you like visual bars. This is just to give you an idea of how all the different REIT markets compare both in market capitalization and in number of issues in each of these different markets and in each of these different sectors: commercial, diversified, healthcare, hospitality. Like I said, I'm happy sharing these slides with you if you want to look at it as a reference later. But all I wanted to point out here is really that US, Japan, Singapore, and Australia are relatively diversified, with the US being the most diversified, and the Hong Kong REIT market, by comparison, is still the thinnest and one of the least developed. Just to give you an idea of some names, I've just copied and pasted here the top REITs in each of these markets, just so you can see both what the names are and roughly what their market caps are, and also what sector each of these are classified in. Some of these are names you may or may not recognize. In the U.S., Simon Property Group, American Tower, Public Storage. Here in Hong Kong, there's really Link REIT, which is by far the biggest. I believe it's bigger than all the other REITs combined, as well as Champion Real Estate Investment Trust, which owns the building that used to be Citigroup Tower, Fortune REIT, and so forth like that. Singapore still has many more REITs than Hong Kong does. And of course, Japan is a much bigger and more developed REIT market as far as Asia Pacific goes. Why am I excited about the REIT market in Asia and the development and issuance of REITs here? Well, this is a list of the top 20 biggest and fastest growing cities in the world. And you'll probably notice a pattern here. 12 of these largest cities are in Asia ex-China, another 3 are in China. So if you want to go down this list, the first one that's not in Asia is New York City in the United States. And then you have Asia, until you get to Sao Paulo in Brazil. So very much if you want to look at global urban property, where is it happening and where are the markets? Most of them are here in this part of the world. So as a little bonus, I just wanted to show 2 little scatter plots that are very useful when I analyze individual properties. I look at these both when I look at the properties held within REITs and when I look at physical properties for investment myself. This one is one that I published on my blog about 3 years ago. This one shows the price per square foot about 100 properties in Sai Ying Pun. This is across about 12 buildings. This one shows the price per square foot as a function of the age of the building. So over here you have a relatively new building, about 3 or 4 years old. Here you have I believe an 8-year-old building, a 9-year-old building, a 13-year-old building, and so forth like that. And really what I wanted to show in this scatter plot is even though buildings tend to appreciate over time, at any given time, older buildings are worth less per square foot than newer buildings are. It's something that may seem obvious, but when you want to look at appreciation, do keep in mind that you have on average a $400 to $1,000 per square foot depreciation in the value of the building that you have to overcome when you're looking at price appreciation. I also just wanted to show how this compares not only on age of the building, but also how much the price per square foot can vary based on how big the apartment is. Here I have red dots and black dots comparing 2 property markets, one in Seung Soi and the other one in Futian in Shenzhen, right across the border. The point of this is that I wanted to show how different property prices are in 2 very nearby areas just because they're on one side of the Chinese border versus the other. Basically what it shows here is that in Futian you can find larger apartments than you can find in Seung Soi, and they tend to get more expensive per square foot as you get to larger apartments, which you don't see quite as much in the Seung Soi apartments. And not so surprisingly, the ones on the Hong Kong side of the border are older and still more valuable than the ones on the China side. I love creating scatter plots like this, and I do it for all sorts of different property markets, and that's how I take a look at them. So 2 more things here. I don't know how much time I want to spend in here. I think I'm a little over time already. I want to give Chris some time. But this is just taking a look at how you measure returns on funds. And I wanted to compare here that when you want to look at the return of something, you don't want to just look at the average return. You want to look at what the risk is. So of all of these 3 different types of investments, even though this one has the green one, has the lowest average rate of return among them, the fact that it's the lowest volatility, it's the lowest risk, means that you could lever it up to receive a higher rate of return with a higher degree of certainty if you wanted to. These are just one of many, many metrics I use when I look at what quality of one investment is versus another. So thank you again. This is my contact info. I'm just going to quickly switch the slides right now and let this get on. There we go.
Good job, Tariq. And any questions for Tariq? Questions before? Yes, sir. Just check the recording. And pardon my voice.